Let's bring in Mohamed El-Erian now. He's a president of Queen's College at Cambridge University and the chief economic advisor at Allianz. Always great to see you, Mohamed. Thank you for being with us. So how are you thinking about this recent action in bond yields? You have said maybe it's not a problem where they are right now, but if they increase further, this could pose some risks to the Fed's sort of flexibility on policy here.
Good morning. Thank you for having me. So bond yields moved a lot the first 5 trading sessions. They moved by 22 basis points in terms of the steepening of the curve. So all the action was in the longer dated maturity. If you ask why, it's not because the growth prospect improved. If anything, they deteriorated. They moved for 2 reasons. One is inflation concerns started increasing, and there were more hesitant buyers recognizing how asymmetrical the valuation outlook was. What I find most interesting, Julie, is that even though that move is relatively small, it got the Fed to U-turn on the taper talk. And that's fascinating to me, the extent to which the Fed is now trying to fine-tune the moves in markets.
So, Mohamed, it's Miles here. Let's stay on that Fed idea around yields and why you think they're so sensitive to those movements. Is it because of impacts in the real economy? We see the housing market continues to drive the U.S. economy specifically, or is it really just an echo of 2013 and how poorly that went and how it took years for the Fed to kind of pull back the markets after that initial taper tantrum as we now know it?
So I think publicly it's the first reason. They know the economy is looking at a worsening short-term outlook. The numbers today, the Beige Book yesterday confirmed that. I think privately is that they are concerned that higher yields will change the appetite for stocks. Remember, stocks are underpinned right now by 2 very strong behavioral conditioners. One is there is no alternative, TINA. But if yields go up, there could be an alternative. And second, the notion of these discounted cash flow models signaling buy because interest rates are so repressed. So I think the sort of less explicit reason is exactly that. They don't want a repeat of 2013. They don't want a repeat of the taper tantrum. They don't want volatility in the stock market to undermine the economy. So, the public reason is the economy is weakening. We will do whatever it takes to make sure that that weakening is limited. But the private reason is they don't want massive volatility in the market.
Mohamed, you've coined what we're seeing in the markets recently. We're seeing a rational bubble. What ultimately pops that bubble? We had really disappointing jobless claims data out this morning. It appears that economic data continues to get worse. Is worsening data over the next few weeks, does that pop that rational bubble?
So first, it wasn't my phrase. I read it in the Financial Times in one of Michael McKenzie's column. And I liked it because it caught the notion that we are in a bubble, but it's rational. What pops it? One would be a reversal by the Fed. I don't think that's going to happen. 2 would be large-scale bankruptcies. That's gonna happen to some extent, but not enough, I think, to change behavior in markets. The third one is some sort of market accident. We are seeing a lot of risk taking. Look what happened to Bitcoins in just 2 days. It lost 20% of their value. We are seeing irresponsible risk taking in certain segments. That is a risk. And fourth, if we were to see another 20 basis point move in yields, that would be bad news. But to be clear, the path of least resistance right now is higher. The market is completely embracing the notion that the Fed and the fiscal authorities are going to pump in a lot of liquidity, and that a lot of that liquidity is going to end up in the marketplace.
And on that, the fiscal side, as we've been talking about on the show this morning, Joe Biden, the president-elect, of course, is going to be laying out his plan to combat COVID and also on the economic front. And there is some talk it could be a $2 trillion plan. We even had one economist on the show the other day saying it could be $2 to $4 trillion if you throw infrastructure in there. Has the market already priced that kind of spending in?
So the market certainly, and you see this today, when there was talk that it would be a $2 trillion package, the market certainly is pricing in a significant fiscal package. And I think we've got to distinguish between willingness and ability. I have no doubt in my mind that the incoming Biden administration wants to go big. They want to go big on relief. They want to go big on infrastructure. They want to go big on local and state government, and for good reason. But they have a razor-thin majority in Congress, razor-thin in the Senate. And getting that through is not going to be easy. Add to that there's questions about the impeachment process, there's question about nominations, there's the COVID. So the market, I think, has priced in a big package that is consistent with what the Biden administration wants to do. The question that the market is going to have to cope with is it able to do so, given what else the Senate has to look at in the next few weeks and months?
And Mohamed, related to everything going on in D.C., I'm curious for your thoughts. I don't know if there's any market implications right now, but I'm just curious for your thoughts on the speed with which companies have come out and made statements against the events of last week, the speed with which corporate leaders seem ready and willing to reimagine, their position in the discourse. Companies are no longer sitting idly by. They now want a stronger voice in sort of, the political conversation in this country. I'm curious just your view on that, because it's such a big shift from the way that I think business leaders thought about their role pretty much, forever until now, it seems.
Yeah, it is a big shift. It's a very sudden shift, and it's one that's warranted by developments. As to the impact on the market, very, very little. You have to understand this market is completely codependent with liquidity injections from fiscal and monetary agencies. And that's what matters for valuations right now. So you're going to get a lot of stuff going on, but that's not going to have a massive impact unless that codependency, which is really, really deeply ingrained right now, changes. You saw the Fed respond really quickly to very small changes in bond yields. That's one side of the dependency. And you've seen the market respond to the Fed signal and the fiscal. So we are in this, what I think is a very unhealthy codependency, but that's what matters right now. Look at today's number. We nearly had 1 million jobless claims, initial jobless claim. That's a big number, and the market has brushed it off completely.
Mohamed, how inflationary do you think a $2 trillion stimulus plan from President Biden will be? And if it is inflationary, does that move the Fed potentially raising rates? Does that move that timeline up?
Yeah, so the Fed wants orderly increase in inflation. The risk the Fed is facing, I think they recognize this, is that on the public side, you may get a major fiscal package. And on the private side, on average, not for everybody, but on average, incomes have actually done well. There's a recent estimate by Jason Furman telling you that there's a 10.5% of GDP gap between the above income growth because of all the support that people have gotten and consumption. So, if we get the green light from COVID, how much of that is going to end up being translated into actual demand? So the market has started to recognize that there is an inflation risk coming from the demand side. And I think what the Fed wants is a gradual increase in inflation, but one that is really orderly. And that's a very delicate balance that it needs to be struck here.
Mohamed, we've been talking all about the United States, but I do want to bring in the global economy, because I'm wondering how you're thinking about a global synchronized recovery. Is it going to be synchronized coming out of the Trump era? Should we be thinking about our interdependence in a different way? Or with the Biden administration, are we going to kind of go back to an older regime on that front?
So think of a race, and it's not going to be synchronized in the beginning. East Asia is way ahead in terms of the recovery, and for good reason. they've gotten control of COVID much better. Europe is going to lag significantly. In fact, if you were to annualize the last few months and the next few months between the best performing Asian economy and the worst performing European economy, that would be an annualized 20 percentage point. So it's a huge difference. The US is going to be somewhere in the middle. So Europe goes into a double dip. Asia continues to recover. The US slows down, but I think avoids a double dip. That's going to be the story for the first 6 to 9 months of this year. Thereafter, Asia slows down and the US and Europe start catching up. So that's how the dynamic is going to play out. And again, we haven't seen that reflected in market valuations, including in the currency market. So it's fascinating to me how divorced the market action is from all this, and for good reasons, because of the amount of intervention by central banks.
Yeah, it is jarring nonetheless at times when you look at that dichotomy. Mohamed, finally, I want to turn in a more wellness-oriented direction, if I might, for just a moment, because I saw an interview that you recently gave where you talked about pulling back from your previous role at PIMCO, for example, to spend more time with your family. And I wonder, as we have come through the pandemic and you've talked to current and former colleagues, has the culture on Wall Street and in corporate America, do you think it's been changing at all as a result of all of this? Do you think that we will see any kind of pullback in a sort of workaholic culture or a willingness to spend more with family? Or do you think we're going to sort of bounce back to that kind of model?
I don't know, Julie, but let me tell you right now that the average family, especially if they have younger kids, is stretched beyond belief. I talk to people who have to homeschool their kids. They have to continue working. Some of them are caring about their parents. I think most companies recognize that mental stress is very high right now, and they're thinking about how do you manage this and get to a sustainable level. And that's going to be a major challenge. When I look at what is not being talked about enough right now, first and foremost is how unequal this shock is. And this has major scarring implication, economic, social, political. And secondly, about the mental stress that a lot of people are going through and are going to have to manage through it. And that's a real priority for companies.
Yes, as it should be. I think it's everyone's problem and priority right now. Mohamed El-Erian, always such a pleasure to talk to you. Thank you so much for spending some time with us this morning. Mohamed, of course, is the president of Queen's College at Cambridge and also chief economic advisor at Allianz. Appreciate it, Mohamed.